This is a, just a little bit, I just removed a little bit of it just to give you guys the nuggets of the presentation I gave at Michael Black's Dealmaker Live talk, which is about building your social media presence. I've talked a lot about raising capital. I'm the author of a book called Raising Private Capital, which is a Bigger Pockets a book and an Amazon bestseller. And then there's the first book out there about raising capital for real estate. There's others that look very similar to that book, but it was the first one out there, and it's the Amazon bestseller. So this presentation is about social media, because we got where we did in real estate and in Bigger Pockets and all those things through social media presence, through YouTube, through Facebook, through all those things. And I put forth to you that you guys can advance your brand as Nick and his team are doing as well, very well here, by making people aware of you through social media. That's what today's talk is going to be about. So back in the day, before social media, and I say back in the day, I'm dating myself, like, 7, 8 years ago, it was about who you knew, right? So maybe you went to college with a broker. And I mean, this happened for me. One of my first equity investors was somebody that went to college with my wife. That's how you got deals done, was by people you knew. If you went to a country club with somebody who is a commercial real estate broker, you likely were going to hear about a deal in your market before somebody else did, right? So it was all about who you knew. But the world has delivered us, look at my screen here, look at my camera here, has delivered us a megaphone, right? And it's this thing right here. And it's the laptop I'm talking to you on, and this phone right here. And that megaphone it's a magic megaphone that with this thing, I can put something out and access literally millions of people in literally hours. I could shoot, any one of y'all right now could take your phone and shoot something that goes viral, that has millions of people to watch, a million people watch it, right? So the world's changed. And so it's no longer about who you know, it's about who knows you. And what social media presence and about a good social media strategy can do is it can make you known by a lot of people very quickly. And you're noticing a lot of new people coming into the space and escalating very fast because they're smart enough to have a good brand, social media, a podcast, a unique story, whatever it is. So I'm going to give you guys the tools to get there yourself as well, or to elevate your brand. Social media, you could just do this, which is just shout into this thing, in this microphone, and talk about who you think should have won the presidential election, or put up pictures of your cats, or put up pictures of your kids, which I put up some pictures of my kids too, and that's okay. But you can just make noise in social media. That's what most people do, is to make noise in social media, because it's very easy to do that. It's very easy to just pick up your phone and type in what you think, right? But what you can also do is you can take social media and make money, produce your brand, find deals, find equity, and advance yourself so that people know you as either a thought leader that offers educational services around real estate, or as someone who's looking to acquire deals, someone who's looking for money for deals, whatever it is. You can build yourself into being a magnet through social media. So the first tool I'm going to give you guys is about your brand, right? And what we're going to get into what that means. And that's the first thing, because again, the brand is pretty much what you say into the megaphone and that. So this is my brand. This is the DeRosa Group. And the mantra for my company is transforming lives through real estate. And what you will see when you deal with us, with my company, is that's our brand. We put a lot of free stuff, a lot of free education on YouTube. I give away a lot of things for free because I believe that real estate can make a difference, but also I try and create a mantra of transparency that goes back to transforming lives through real estate, because it's really not just about making money. It's about how much of a difference can I make with the business that I'm creating. So that's why it goes back to a lot of our brand, and everything that we do falls back to how can I transform someone's lives through real estate, right? I'll give you an interesting, not bragging on ourselves, but this is an interesting way this brand plays in. For our social media, what we do is when we broadcast a deal that we're doing, what we talk about the most is how it's going to impact the tenants' lives that live there, how it's going to monetize investors' lives as well, but how the property itself is going to, in general, not to get too airy-fairy, but make the world a better place. We put that on our social media presence, and that's the brand that we stand behind. So really, it's a question for you guys, is what brand do you want to stand behind? And if you have a cool name like this, then you should trademark it. Whatever brand you have, consider protecting it. So the brand can get broken down into your backstory, and Transforming Lives Through Real Estate has a long backstory for me and my wife, Liz. The avatar, I'll get into that in a second. And then what your superpower is. And so you guys know, some of you guys that know me at all or follow me at all and on social know that I'm a superhero junkie. So we'll get into that too. So what is your story, right? That your story is, I mean, what I encourage you guys to do, and we've tried as hard as we could to do that, and I did this as best as I could in raising private capital, is to talk about your own real experience through real estate or through before real estate, whatever it is. What impacts have the world made upon you that would define a brand for yourselves? What the platform upon which you stand upon for your real estate business? What are you all about, right? And I think that it takes a little bit of courage to get vulnerable and put yourself out there. But I can tell you, the social media world loves it when people get real. They hate it. They don't hate it, but they don't respond to it as much when you pound your chest. It probably feels good to do that, but they respond to it a lot more when you get real and you talk about real stories and real things instead of just puffing yourself on social. Real life stories do a lot better in that. So tell your story, not somebody else's, not some made up story or anything like that. The next thing is the avatar, right? And the avatar is not just the blue guy that lives on the other planet. The avatar is the target person that you want to go after. So for us, our target is like early age baby boomers to late age Gen Xers, right? That's our investor target. Our target for people that want to learn from us or help us find deals and be deal bird dogs for us are younger generations. And so the social platforms I use to target investors is different than the social platforms I use to target potential partners, potential students. Two separate avatars, two separate languages that people speak, and two separate social platforms that they tend to go on, right? So bottom line is, if you're looking to build a presence for yourself, a podcast, let's say, the bigger question you want to ask is not just, I'm going to have a podcast and talk about real estate. Who do I want to have listen to that show? That's your avatar. And if you can define their age, where they live, what they do for a living, their median income, as much as you can around that, then you'll be able to develop something that'll be a magnet for who you want to have watch it, right? So get very, very clear on the avatar you're trying to attract social. It's a mistake to say, I want to attract everybody, or I want anybody looking to invest, or anybody looking to learn, or anybody looking to whatever. There's no anybody out there. You'll attract whatever you get. It's a shotgun approach, but shotgun approach does not work on social media. I mean, it does if you want to dump a lot of money behind it through social media marketing, but if you can do more sniper level targeted production to put out just the right SEO and just the right product that your avatar is going to be gravitated towards, it's going to fly off the handle, right? And the last thing is your superpower. And like I said, I'm a superhero dork, so there's my boy Captain America. But what I'm talking about here is, what is your greatness, right? What, like, if you had to brag on yourself and say, okay, well, I'm great at, and greatness with when it comes to something to produce social. So I'm pretty good at explaining stuff. So that's how I got into YouTube many, many years ago, right? I'm not that good of a writer. I pushed myself through writing a book, but that's why I don't write too many blogs. A lot of people do a lot of writing of blogs and things like that. If that's your shtick, do it. If you're a great listener, a good interviewer, a good conversationalist, you should have a podcast, right? But whatever it is, find your superpower by using, there are assessments out there like the Strengthsfinder, which is phenomenal. None of people use that one. Strengthsfinder Predictive Index. Colby is a product that's recommended quite a bit by Strategic Coach. If you guys have read Traction, that's a derivative book of Strategic Coach. Colby's a great assessment. The DISC is a good assessment as well. So take these assessments and just be able to look yourself in the mirror. And as the final thing, ask your friends and family. Ask your mama, hey mama, what am I really good at? What am I in, tell your mom or your wife or your friend or your neighbor or the person you go to church with or whatever. Ask them, hey, listen, I'm going to build a phenomenal social media presence around real estate. How do you think I could contribute to that? Like, what do you think that would be the best for me? Should I be a writer? Should I be a speaker? Should I go on video? Am I good at explaining stuff? Am I good at being funny? Am I good at interviewing? What God-given talent do I have that would bring me through social media? Because it's best. I mean, anybody could learn how to do these things, but it's best to take something that's already easy for you, and your audience is going to see that you're a natural at this stuff. And people are not a natural at everything. If you take the thing you're a natural at and just focus on that. And too many people on social are trying to do everything. They've got an Instagram page, they got a YouTube page, they're writing articles, they're going on podcasts, and it's like shotgun social media. You'll get somewhere that way, but you're gonna get somewhere a lot faster if you focus on your superpower. Right? So that's your brand, guys. Your story, your avatar, and your superpower. All those things congeal into your brand, right? Now, here's a few tips when you guys start talking into that megaphone. Now, I talked about what you say into the megaphone. That's your brand. Two things: keep it consistent and keep it authentic, right? So keep it consistent means that when you're doing posts, do them regularly, right? The world loses attention very, very fast, just like this little girl here sitting in class, right? At the end of the day, the world has a lot of media that's coming at it. And if you don't put things out on a regular basis, if you put out YouTube videos or podcasts or whatever, when you feel like it, or when you come across it, or a Facebook post or whatever it is, whenever you do, whenever it occurs to you, whenever just the idea comes, then the world will start to lose sight of you. But if you put out something like Facebook post, try this. Somebody commit to me, they'll try it in the chat bar, right? Somebody commit to me, they'll do a social media post every day for the next 30 days on one social outlet, Facebook or Instagram or TikTok. Pick one of those three, right? Then put out a real estate related post every day for 30 days. I'll tell you, people will start coming to you after like post 8 or 9. Hey, you invest in real estate, right? And these are people that you never talked about real estate, but they just like psychologically, they're drawn to you. Like, you invest in real estate, don't you? I keep seeing these posts you do about real estate because you're starting to show up in their feed. You're starting to talk to them and stuff like that through they're starting to see it. And they realize that you're that person they went to high school with, but also invest in real estate. And you happen to know that their brother-in-law also invests in real estate, and their brother-in-law maybe also have a deal they want to sell, or maybe there's some collaboration that can happen. The best thing you can use social to do is obviously to attract investors to yourself and attract people, the deal finders. But beyond that, it's about telling the world what you're passionate about, what you're up to in real estate investing, and it will automatically magnetize people to you, right? So consistent, regular posts that are on your on brand, on your message, right? Now, tell the truth. Like I said, don't be BSing people, and don't sell people about anything. And there's certain, I've seen people get nasty letters from the SEC when they sell too much on Facebook or on social and things like that. So first of all, you don't want to get yourselves in trouble. Secondly, just tell people. Nobody wants to get sold to, but everybody wants to get taught, right? So become a teacher on social media. Do not become a salesperson, right? Now, some of you may feel a slight sting on this next slide, okay? Fake it till you make it, okay? Fake it till you make it used to be the thing from back in the day that people would talk about. And you'd be like, I've done all this work and all this real estate stuff, and I've got this huge team and done all this or whatever it is. And you hear people that put out resumes for themselves that either don't quite add up or whatever it is. But the thing is, because of Google, and because of Facebook, and because of social media, fake it till you make it's now BS, right? You can't fake it till you make it. You got to tell the truth. And when you see people faking it till you make it, these are some things you may see, right? We know that's not your Lamborghini, okay? We know it. We know that's not your airplane. So don't be telling me it is, unless it is, but it's probably not, right? And some of you may feel a real sting here, but let's just get real, okay? We also know that you did not just buy that apartment building by yourself, okay? So get real. Talk about your team. Talk about the people, the great investors that came to you on that. But people know for a fact when you put out, I've just bought this apartment complex. Okay. We know, and anybody that knows anything about the business knows you didn't do that, right? And people that believed it are going to very quickly figure it out that you didn't just write a check out of your own pocket for that apartment complex. So don't BS people, right? Don't fake it till you make it. Fake it till you make it is dead. Okay. Now, be authentic. Here's a real post you can do. I really did buy that 336 unit apartment complex, but I used a team. Okay. So here's a real post. I am so grateful. Everybody start with gratitude. Everybody loves gratitude, right? I am grateful that I have this team, and tag them, right? These people, helped me buy this apartment building. They helped me raise capital. They helped me asset manage. They helped me underwrite the deal. They found the deal, whatever it is that they did that contributed to this deal that we did. I didn't do, we did, right? I'm grateful for them. And this building is going to be amazing, right? And I'm grateful for my passive investors. Don't tag them because they might want to be behind the scenes, right? So I'm grateful for my passive investors that join me on this deal, that put their hard-earned money into this project, and I'm going to do them proud, and I'm going to make them a great return, and they're going to be amazed at the amount of returns that we made on this deal. And even like if you had a toehold in that deal, if you raised 200,000 for a 500 unit portfolio, that's okay. Admit it, right? People don't want to do that, but admit the truth. I raised a small amount of money for this deal, but I'm grateful that I'm a part of it. And thank you for giving me a shot at this thing. And don't believe me, just watch. I am going to take off and do my next deal. It's going to be bigger and bigger and bigger. That is a real Facebook post. That's a real social media post, and that'll give you goosebumps, right? So it's easier and it's more egocentric to talk about how you did these things by yourself, but people see through it, right? So beyond consistency and telling the truth, let's talk about changing things up, okay? The algorithms that social media platforms use are extremely complex. It's like but an algorithm is a funny way of saying an equation, okay? So the equations that social media platforms use, like when you guys go on your phone right now to go and search social media, what I see on my social and what Nicholas sees on his social are two different things, even if we have the exact same amount of Facebook friends or social media friends, and that's because the algorithms determine what we're going to see. It's complex equations that determine what social media is going to put in front of your eyes. That's to do with when you're on and who you're friends with and what you look at, what you click on, what you don't click on, and it's interestingly enough that people over the years figured out how to game the algorithms. If you figure out, oh, SEO and SEO can do this, there are classes you could take on how to game social media, on how to game Facebook or YouTube or LinkedIn or whatever it is to make those platforms put things to the top of the list. I've seen top of the fold classes that people can do, that people put out there, right? The thing is, this guy figured out that you could game his platform, and he wasn't so happy about it. And he made that face and he said, okay, what we're going to do is we're going to start changing the algorithm. I'll give you a fun fact. TikTok changes their algorithm every day. Every day. So if you do a TikTok post, and TikTok is growing exponentially. So TikTok's not just for dancing anymore, right? TikTok's a real platform that there's one guy that I know that's done over $1 million in education product in 1 year on TikTok. He sold that on TikTok. TikTok's a real place now, right? So because of that TikTok changing the algorithm, you have to constantly throw spaghetti up against the wall if you want to be successful with TikTok, right? And that's because they change their algorithm every day. If you put one post out that gets 10,000 views on TikTok today, it might not get the same amount of views tomorrow because they change their algorithm. So you got to keep changing things up. This is a post that my wife encouraged me to shoot while we were walking through one of our apartment buildings. She's like, hey, why don't you tell the story of how we bought this building, right? So I do. This post that my wife pulls out her cell phone and shoots, has like 250, like 250,000 views, 250,000 views on YouTube, right? And it's just a random, just try it out, see if it sticks, right? Sometimes the spaghetti sticks. So constantly on social, whatever social platforms you're on, or a podcast or whatever it is you're running, try new things. It's gonna flop, but something's gonna stick, right? Like this did. All eyes are not equal. Don't ever do a social post hoping that you get 1 million views. If you want to get 1 million views, put a picture of yourself falling off of a skateboard, right? Do that. That'll get you 1 million views. If you want eyes that are going to matter, that are going to produce deals for you or investments or whatever it may be, put out something that's to your avatar, that your investor base is going to ring your phone on, right? And the world's changing. One last thing, right? This is why this matters, right? This chart is the world's confidence in stocks, or the US's confidence in stocks, according to Gallup, right? Now, if you notice the year, this is during the peak of stocks, or this is during the crash, right? Stock market's gone up, right? Since then, this is the 2007, 2008 crash. The stock market's gone up since then, but look at this. America's continued to lose faith in the stock market, right? What happens? The stock market takes a sneeze the wrong way again, Okay. What happens to America's faith? Where is America going to go to build their wealth? They're going to go to the people they're friends with on Facebook that are talking about buying apartment buildings. They're going to say, screw this stock market. I'm done. I'm going to go somewhere else to to achieve my wealth goals, to build my 401k, to build my IRA, whatever it is. Right. So in more fun facts, 2010 was $5 trillion in IRAs in America. In 2000, this year, there was 12.5. This data is courtesy of my good friends at NewView, which is a phenomenal IRA custodian you guys need to check out. There's $12 trillion in IRAs. It's grown by 7.5 trillion in the last 11 years, right? But here's a fun fact. Only 2% of that, 250 billion, is invested in alternative investments like what we do. Anything but Wall Street. How much is that 2% going to change the next time Wall Street takes a dip, right? The next time the Dow falls again, right? And who are they going to go to? The people that they're friends with on social. And oh, by the way, the people that are worried about self-directed IRAs going away because they're tracking this new bill that Biden has out and stuff like that, that's been stripped. So the IRA is still alive. It's no longer going to get attacked. It's no longer going to get taxed. They can still invest in private placements for the foreseeable future through IRA accounts, thanks to the movement that people like us created on social. You know, I joined petitions and things like that through social media to make sure that my Congress people knew that IRAs are a way that we make a living, all of us, and that people can make alternative investments through my company. And we want that to continue. And so that got shot down because of social movements that happened around it. Okay. So our chance here, guys, is to get this number way up and make people more and more aware of what we do so they can build their financial wealth. That's my company logo, DeRosaGroup.com. My book's Raising Private Capital. If you guys can check that out on Amazon or Bigger Pockets. And if you haven't read it yet, would love to have you check it out. So that's it, Nick. That's what I got, brother.
Awesome. Thanks, Matt. So anyone have questions for Matt on social media? And then we're going to do some Q&A just about general real estate and markets.
Or anything.
I got one.
I'll talk about anything. My favorite topic is, what do y'all want to talk about?
I got one for you, Matt.
Who wants to go first? I will.
Go ahead, Charlie.
Go ahead, Jay
Matt,
Scott.
first off, I really appreciate your candor in everything that you present and do. I met you for the first time at the BP Con earlier in the month, and
awesome.
After you'd answered a lot of questions from others, you took
I remember
more pointed questions from me, and I really appreciate the fact that you were, you stripped away the bullshit and you told me, rather than giving me the high level BS that a lot of people still do. Yeah. So I respect you for that massively. So here's my simple question, I guess. In your presentation, when you mentioned about the avatars, you mentioned that you have to project yourself to the markets, to the type of people, so that you're looking to target. So how do you separate the different market targets or the market avatars as in your marketing concepts? Because the way I look at it is that you got to do it in a different format to who you're trying to target, or am I wrong?
No, well, it depends. You can't really have more than, say, 2 avatars. My company has 2. And I don't think, I think that you've got to get centric enough on who you want to talk to the point where you can define that avatar. And it doesn't mean that I won't take an investment from someone who's not an early baby boomer or a late Gen Xer, right? But I turn them away. If, oh no, I'm sorry, you're too young, But there is a bell curve, right? Where my avatar is at the peak of the bell curve, and there's flats on the outside. So Charlie, what are we attracting capital for you? Are we attracting deals? Are we attracting students? Are we attracting partners? What are you looking to build?
I'm looking to attract, essentially through the fund we have, accredited investors.
Got it. You gotta get tighter than that.
That would be our main focus.
I got it. You got to think about think in your head about what the 3 best things about what your fund is. Is it like, well, the geography, it's, geocentric, or its return profile is great, or it's cash flow heavy, whatever like bragging rights you want to put on your fund, right? And then think like, okay, what people would benefit the most from this? We have a fund as well, right? My fund is cash heavy, right? Like we do a big cash flow. My fund gives liquidity so they can get their money back whenever they want it, right? And it's diversified across different asset classes, not just multifamily, right? So I did the math on who wants that. A millennial does not want liquidity. They don't want their money back, right? Gen X or Gen Baby Boomer does. And above a certain income level does. And someone that knows about geographic diversity does. So it's got to be a certain income level, accredited. I even have it nailed down to what geography I think they live in, right? And so I would go as granular as you can describing the avatar. You might get it wrong, but you'll figure out real quick if you've got it wrong. But again, go back to the three benefits that what you offer is, and say who would benefit the most from that. Does that help?
Yeah, it does. Thank you.
Cool. Yeah, you're welcome.
Cool. I'll go next, Matt. I was just
What's up, Eric?
my name's Eric Chatterton. Yeah, I'm out of Dallas, Texas. I connected with some of these guys up at Nick's Meetup just last week and
Nice.
had a great time with them. I've been in the space now about a year, just about to close on my second property. When you were talking about posting every day and who's going to take the challenge and post once a day for 30 days. So that's something I would love to do. I've been putting out content occasionally, seeing how that works, what kind of feedback. But my question is for someone that's kind of new to putting out content, I have no problem talking in front of a camera or whatever. But what I'm wondering is, how do you come up with that content every single day for 30 days? Like, how would you do it?
Okay, what I would do if I were you, and if you're willing to take on the 30-day challenge, I'm going to answer your question. If you'll take the 30-day challenge, I'm not going to offer this to everybody. I'm offering this because you're the cojones to offer it up first, right? So nobody else gets this except for Eric. Reach out to Nick offline, okay?
Okay.
DM him to get my email address, and I will do a 30-minute call with you. If you do those 30, if you do your 30 posts and you can show me you did, I'll give you just 30 minutes of just pick my brain, talk real estate, shop, help you find a deal, whatever value you want. Okay. All
Sounds good to me.
Oh yeah.
So DM
Nice,
Nick
Matt.
and I'll give you 30 minutes, but you got to do and me and Nick are going to hold you accountable to you doing that 30-day the 30 days of posting. Okay. Now,
very good.
got it. And weekends too.
Okay.
So what I would do if I were you, because you've been in the space for a year, you said, right?
Mm-hmm.
Too many people fake it till they make it still, right? And the best way for you to go against faking it till you make it in the space that you're in is admitting that you're only been in the space for a year, right? Like, hey, newbie, new guy. I think that there should be a new investor podcast, a new investor YouTube channel, if I were to start over again, that's what I would do immediately. Is I would start documenting my journey as a brand new investor and start like, oh, I screwed up today, offered too much or didn't offer enough, lost an investor today, whatever it is, or hey, had a win. So I would document your journey and maybe do like a 30-second TikTok, or TikTok sucks for TikTok is like an artist space. You got to be really creative to be on TikTok. So maybe do like an Instagram Reels for 30 seconds every day, or a Facebook, and you can flip it on it, or maybe actually, put it on TikTok, and then TikTok's great. You can pull it down, you can put it on Facebook, and you can put it on Instagram. So what's great about TikTok is they let you pull their content off of their platform and put it elsewhere, right? So maybe put a 30-second, like, hey, I'm Eric. This is what I'm up to today. This is what I did for my real estate business. This is just give a quick journey and just get vulnerable with it on I'm feeling stuck today, man. I'm feeling stuck today. Just put yourself out there, whatever it is. That's what I would do, because that's where you're at. And too many people don't own exactly where they are and put real conversations with the world. Does that help?
It does. And it hit home a lot with me when you were saying the fake it till you make it thing. And I have a little personal experience. I used to be in the solar industry, and the old company I was with, I started doing all this real estate stuff for the last 12 months, but didn't start posting until I closed on pretty much our first deal. And I just got brought in as a small piece of it because I raised a few $1,000,000 for him. But once I posted, it was weird. All the people at my old company were like, what the heck, like it was almost instant lack of credibility, because I went from being the solar guy to all of a sudden being a real estate guru, which I wasn't trying to claim. I was just putting like, hey, happy about, you know, this new closing. And when you said that, I was like, man, that's exactly what happened to me. You know, I wasn't trying to claim I was the expert, but I was, you know, happy about the win. And only with that select group, it backfired, but everyone outside of that group, it's been working really well.
That's great. And what I think that people are realizing, you're going to get pushback when you start painting yourself with a new paintbrush, right? The world's going to say, oh, wait, you're the other guy. You're my drinking buddy. You're not the real estate guy, you know, or you're the this person. That's how I know you. You're not this. That's who you're saying you are. And that's not true. So you're going to get pushback from the world as you start to say, no, this is who I am now. And I'm going to be this. And this is what I'm going to put out on my social presence. So that's one of those transformational things you have, is the world figures out, no, he's not that. When you do that social media transformation from this person to that person, you're always going to get blowback, but that's okay. So if you take the challenge up, Nick will get my information. I'll do a 30-minute call with you. Okay.
Deal. Thanks.
Cool. All right. Good luck, brother.
Eric, I look forward to seeing your posts, mate.
All right, find me. I'll be up there.
You've got a lot of people holding you accountable now, Eric.
That's right. I got 27 of them now.
Recorded.
You guys all got to go follow my post though. Thanks, Matt.
You're welcome. Anybody else?
Hey, I'd love to jump in. Tony Castronovo from Houston.
What's up, Tony?
Hey, Matt. This is a little bit of a selfish question, and I'll put your disclaimer out. I know you're not an attorney, but I'm going to ask a question and see if you have any experience here. So in dealing with a 506C syndication, and obviously you need accredited investors, when folks have the option to perhaps come in under an LLC and kind of pool funds together, say 2 or 3 guys, do all 3 or 2 or however many have to be accredited, or is the LLC accredited just with one investor being accredited?
So that's a dicey area, right? And there are people that have taken a bunch of non-accrediteds and put them into an LLC and have that LLC invest as a way to aggregate money. You can't really do that. Like the managing member of the LLC needs to be accredited. And the LLC as I understand it, again, I'm not a lawyer, right? But my lawyer told me that the LLC needs to have like an aggregate net worth of something like 5 million, which is a lot, right? And so it ups the game a lot. The thing is that if they're getting into, if they're doing an LLC for 1 or 2 reasons, right? Number one, to get into an accredited deal when somebody in that LLC is not accredited, right? That's one way. That's one way to do it. It's one reason why. That's a no-no. If they're doing it because they want to put in a little, like this guy's got 25K, this guy's got 25K, and they want to get up to your minimum of 50, you can waive your minimum. So just freaking waive your minimum. Don't worry about this LLC mess, right? Just, okay, I'll take your 2 for your 25 and your 25. Just give me your word, you give me 50 next time, right? You can waive your minimum to whatever you want. A good operating agreement should allow you to do that. The other reason they may be doing an LLC is because they think they need to do it for liability reasons, or because they think they're doing it for tax write-offs, right? Well, I get tax purposes or whatever. They don't get any liability. There's no further liability protection they get. They're protected by the LLC you create. Like, so Tony's LLC protects them against slip and falls or liability suits or whatever it is. So they don't need it for liability lawsuits. And there are no tax advantages that an LLC gives you, period. An LLC is a pass-through entity. So if it has a loss, so do you, right? It just passes everything through. So the LLC is an overused vehicle in a lot of ways, especially by investors. I have many investors that come in with an LLC. The one time that I say that I see people do it is if he's got a portfolio of a bunch of rentals with an LLC, and that LLC is investing in the deal too, especially if their spouse is the manager of the LLC and they want their spouse to qualify for real estate professional status, not to like get too complicated. But I see a lot of people use LLCs to justify real estate professional status for like a high income earner with a spouse that's a real estate professional. Like that equation happens all the time in this business. And there you need an LLC. So But aggregating investors, I think that's actually dicey. I would steer you away from that.
Okay. All right. Thanks, Matt.
I hope that helps. I know that's like a 5-minute answer to a 10-second question, but yeah.
Yeah, and some of the reasons why they would want to do that, I totally get. And you can kind of boil it all down to it's the whole accredited versus non-accredited thing. Because I totally agree. We can waive the minimum, all that good stuff, but
here's the way you get around the non-accredited thing is you do this, and my buddy Neil Bawa gave me this idea. It's brilliant. Is once you get up to a good clip where you're doing if you got a couple of deals going on a year, do a 506c, 506c in a row and use the marketing potential that it allows you to do, that the solicitation you can do, and do big social media presence, big Facebook, big Instagram, posts, solicit, hey, look at me, right? Do that, build your base deep, and you're going to get a lot of non-accrediteds. They're going to come to you through the solicitations that you do, right? So do 506c, then do a 506b, right? So do a 506b once or twice a year to cover your non-accredited investors. Okay. Does that make sense? I kind of have a dollar amount where under a certain dollar, I will do a 506b because I know I can fill it. And we have a large following of non-accredited investors at my company. So we try and take care of them because I believe that these kind of things should be offered to everybody. And so I think it's a travesty that only accrediteds can invest when I solicit. So I try and fight back on that by doing as many 506Bs as I can. So anyway, that's the way you get around it.
I love it, man. Yeah.
You're welcome, brother.
Matt, what you just said, of your investor base, what percentage or ratio are accredited versus non?
It used to be 70% non. Then that's thanks to Bigger Pockets and YouTube. That's just us because that's the microphone I'm carrying around, and that's I'm grateful to have that. And so with the first couple of deals that we did, it was like 50 to 60% self-directed IRAs. The majority of non-accredited investors are going to come in with a self-directed IRA because that's where they keep their wealth, right? A accredited investor is more concerned about income tax, those kinds of things. So they're going to come in with cash, right? And where are you, Charlie? Conversation you're going to have with accrediteds goes back to your avatar. And this is your question, but I forgot to tell you something. That if you're going to talk to accrediteds, the big thing that accrediteds want to talk to you about is tax minimization. Right? So you want to talk about how you can save on income tax. That will get you the accredited you want to get to. A non-accredited is about like get in the game, make cash flow, alternative investing. That's non-accredited language, right? And that. So we're now at like a 20% accredited, non-accredited ratio because we did, like I was telling Tony to do, we did a bunch of 506Cs and did a big marketing campaign and pushed that way and stuff like that. So now we're blended with a lot more accrediteds. Because of that shift that we did a bunch of C's and put a marketing budget behind them.
Cool. Thank you.
Yeah, but we did like 10 syndications. Yeah, we're on our 15th right now. We did 10 syndications in a row, all 506B. And that's just who we were. That's just what worked for us. And then we started doing C's, and that shifted the needle.
Yeah.
No, I think B is a good place to start for everybody. I believe people should start with B personally.
I have a question kind of on a different side. I might be kind of the minority here working on the debt side of the business for multifamily. So I work on a large team that does probably 500 million in production a year. And then I'm also looking at building my book of business. So kind of was curious your thoughts on how to position yourself in the market to be kind of the go-to source for groups when they're looking for debt options.
Jack, you are in such a great opportunity, man. You are in what I think to be one of the most misunderstood seats in this industry, right? People think it's just buy multifamily, find the equity, and it'll come, right? But people don't really understand everything. There's so much education you could do on like, what is bridge debt? Simply, I won't do bridge debt because, whatever. Like, we do bridge debt sometimes, but sometimes we do Freddie floater. Sometimes we do this, sometimes you do that. There's a lot of education you can offer on, to us on finance terms and rates that are changing and like all kinds of cool stuff. What makes, like, how do they determine an apartment building interest rate? You know, and how does that affect this and that affect this? Because it's all like, it's like, you know, it's all like a moving ocean where this goes up and that has to go down and everything like that. So there's a lot of explaining you could do. Now, I would personally take that conversation if I were you to LinkedIn, right? So I would do like LinkedIn posts, see if LinkedIn will let you do video, because LinkedIn, like, they're weird about linking StreamYard to your LinkedIn portfolio. If you can get it approved, then you've kind of got a golden egg there, because LinkedIn is a high affinity for video, but it doesn't talk well with StreamYard. So if you can make that happen, then you could do your own little mini show on LinkedIn, or bring in interview guests and stuff like that, but really become the person that's there to make real estate debt understandable and simple for people. Right. So
that's what I would do. Outside of, you know, deal postings or closings that are actually informative in kind of real-time information.
Yeah. If the syndicator, if the principal of the deal is okay with you putting their deal out, you could be like, hey, I just financed this, you know, like, we made that happen, you know, like I would certainly brag on your side of the deal too, on what it is you're financing. And one last thing, I think that, like, a lot of mortgage brokers I talk to don't want to do anything like that. It's like 10 million or up as well. They're like, oh, you know, below 10 million, it's not worth my time. If you've got an outlet for like 2 to 8 million for a lot of newer syndicators that are just getting into the space, world's your oyster. There's not a lot of brokers. Not that you should only focus there, but I think you should have an outlet or a product or even a referral partner that can take the lower end, the lower tier stuff, and then educate on that too. Because most people getting going that don't know where to go or what to do, and nobody wants to help them, are going to be buying in that tranche.
Yeah, we actually have a few bridge groups that are going
so
down.
Interview them, find out what their terms are, find out, like, put a post. Like, honestly, I would watch this video. How do you finance a $3 million apartment building deal without a personal guarantee? There you go. If you could do a video on doing a $3 million apartment building deal with no personal guarantee, you'd get a bunch of hits. Everybody here on this thing would watch. Raise your hand if you watch that video. There you go. There's like 10 views.
I didn't realize I had so much knowledge to share, so I appreciate it.
Yeah, you think it's the biggest mistake that we all make is we think that everybody knows what we know, right? And I think that you got to realize, and you called yourself the minority here with regards to industry, right? So you're
on this call, yeah.
Yeah, well, here, yes, but I think that it's actually a good opportunity for you, because nobody's out there talking about that. Not even mortgage brokers, because the good mortgage brokers know their phone rings, you know?
Hey, Jack, just one thing. Good to see you here, Jack.
Yeah.
Just kind of real live case study. I had a friend who was an attorney in New York City. He was working for a bigger firm. I was kind of pushing him to start doing his own thing. And I started seeing him on LinkedIn. He'd do something called Leasing Minute, right? So he was talking about like a case study that he had with letters of credit with different tenants, right? And just kind of talk about it for 2 minutes. And the consistency was super important. And I just checked in with him. This was about 3 months ago. I'd see him consistently posting. 3 months ago, he launched his own firm, you know, his own attorney firm, you know, and he just kind of built that social media presence, educating people, and people constantly seeing him top of mind, you know, built up his business where he was able to launch his own thing.
There's a lot of people like that just you build yourself that big enough following, before you know it, you can monetize the following for anything that you want. So yeah, good luck, Jack. I see a lot of awesome potential there.
Awesome, appreciate it.
Yeah, man.
I have a quick question, Matt, if that's okay.
What's up, Nicole?
Hi, how are you?
Awesome.
I'm actually in the New York City area, so I've met you a couple of times, maybe years ago at random meetups, New York City, NYC RIA and stuff like that. Just way back in the day. But in any case,
yeah.
with Teresa,
yes.
Yeah, yeah. So just going back to the 506B and C and how you set up your syndications, you don't know, but I am focused on trying to help as many 506B investors get into the space. So
for you,
do you think that creating a separate fund, like doing a 506C syndication with a fund that allows 506B to partner together, like, is that a good kind of strategy, or what's the best way to attack at that with keeping, like, getting the raise you still need, you know?
I believe my lawyer told me you could do a sub 506B that invests into a C, I think. But it depends on what your what your long-term goal is here. There's something called a Reg A, like a Reg A plus, right? That allows you to solicit, but also attract non-accrediteds, right? So it's expensive and it takes a long time to set up, you know?
Like a crowd fund?
No, it's a different thing. That's another thing. You could do crowdfunding. Like you could do a Reg CF. Reg CF that was put on through Obama through the Jobs Act allowed your house sounds like my house did a minute ago. I can't believe they didn't get up. I think they did though. I think I hear them upstairs chirping. My wife's off her call now, so now she's dealing with it, right? Anyway, you could do a Reg CF, which is something that allows you to go to people, and that's limited. Their investments limited on how much their income is. Most people that do a Reg CF do share prices of $1,000 to $5,000 because it's limited on income. It can be cumbersome. We work with a company called Republic.co, and it was okay experience. They can put it all together for you, but it's expensive and that. But a Reg A is different. A Reg A allows you to solicit, so you can market and say, hey, you know, non-accrediteds are okay, get in my deal. I think there's a time window for how long it can stay active. It can't be open forever. But it also lets you solicit and you can take nons. So that's that. Your idea to syndicate a 506B is not a bad idea. I would run that by a syndication attorney, or run it by, like, if you've got a syndicate, like a master syndicator over here that you want to roll your 506B into, right? Ask them to talk to their syndication attorney, right? If anybody came to me and says, hey, I want to raise a bunch of money for your deal, I would say, sure, talk to my syndicate. You know, of course they're going to want to put you on the phone with the syndication attorney. So, but you remember your cost to create that 506B is going to be around 10 to 15K. Okay. To create that. So it needs to be big enough that it's going to be, that you're going to create enough momentum that'll be worth your while and cover your startup costs and stuff too. Okay.
Yep, I got it. Thanks. I have a call set up with Lisa, Lisa Taylor.
Mm-hmm.
Yeah. So I wanted to run some ideas by her and get some more information from her. But yeah. Mm-hmm. So thank you. Appreciate that.
Oh, you're welcome. Yeah, I love what you're. I love what you're doing with that. Thank you. It's our mission. Like, again, it's my company mission to make what we do available to everybody. And the laws have to change to do that, but that's okay. So I'm all about bringing non-accredited into the space, and accrediteds too, and offering what we do to everybody, includes full spectrum, right? So my vision, Nicole, one day is to buy an apartment building and to sell shares of that apartment building to the tenants that live there. Talk about that, right? Because I can do that. I can take a sub-reg CF and sell shares at $1,000 a piece. So if the tenants can afford $1,000, I'm not going to give it to them. They got to buy it, right? But they can buy for $1,000. They can buy a share of the reg CF into that fund. You talk about having eyes on the street. They're not going to put up with their noisy neighbors anymore, and they're sure going to pick up their trash, and they're going to treat the place like it's their own because it is, right? So, and even if they move out, they can keep their equity and everything like that. I mean, yeah,
I love that idea, and I may borrow it.
Do it. I hope you do. I hope you do. I hope more people do that, because it's just about equity sharing, you know, or equity, just making equity available to more people, not giving it away. It's okay to sell it, you know? So, cool. Thank you, Nicole.
Any other questions?
Matt, what's next for you?
Where are you? We got, like I said, I get 4 under contract right now. We actually started doing small deals because we found that nobody was paying attention to the small space. Everybody was clamoring over themselves to get into the big stuff. And so we had a dry spell for a while. Like we closed, our first deal was this year was 152 units that we closed in July. And it was like a lot of bidding, a lot of banging our head up against the wall, and a lot of brain damage to get to July. And I think we underwrote like 250 deals to get to that one. So we were like, man, we're just going to pivot. So we put under contract a 32 unit, a 48 unit, and a 37 unit. So we had all those small deals under contract, and then we catch lightning in a bottle and catch a 227 unit. So now I have all 4 of those under contract right now that we're assembling in that. So I'm going to have an interesting fourth quarter getting all that assembled and that. I mean, moving forward, I think that we had a goal of 50 million new assets under management in 2021. I'm probably going to increase that, and we hit it. We're going to hit it once we hit everything that I just said. Next year, I'm just looking at the tea leaves, man. You know, and I mean, I'm wrong all the time, but the tea leaves that I believe are telling me that as much as like people go, oh, things are overpriced and whatnot. Well, you got to see where the puck's going, right? Amazon is starting to pay $250. It's starting to pay $25 an hour plus a $3,000 signing bonus to work at Amazon, right? At the Amazon warehouses. Okay. Some financial planning firms are paying entry-level positions at $35 an hour, right? For paralegals and things like that. People that used to make $20 an hour are now making $35 an hour, right? Wages are going way, way, way up from what I've seen. The economists that I talk to, they're way smarter than me, are telling me that we're actually going to have a supply. Think about this. What happens when all the container ships that are all sitting off the coastline right now that we all read articles about, there's like 60 of them sitting off of Long Beach, and there's, and they're slowly dissolving, right? But at some point, very quickly, and it's already working, it's all going to happen like this. So we're going to have a supply glut in this country. So we're going to have a lot of materials, a big influx, it's still money, and supplies are going to go down and all that. So I think there's going to be a good period to buy things because then we're going to bump up into more inflation and everything like that. So we're planning on doing a lot of acquisitions in the next 6 months because I think that there's a lot's going to go on sale. We're also going to get into new construction to take advantage of what I think to be an overcorrection for the bump in material cost and things like that. So I think that we're looking to play that too. And so we're going to set maybe $100 million acquisition goal for next year, which is pretty big for us, for our size company. So I think that we're going to go against what people are saying. Is they're like, oh no, it's too overpriced, it's too expensive, whatever. Well, it is today. And if you believe that it's overpriced today, when people are making, the average American that lives in one of my properties makes about $20 an hour, right? If their wages go to 30 or 35 in the next couple of years, like what does that do to their rents, their NOI, their spending power, the amount of amenities I can provide them in exchange for more rent? Like I can give them granite countertops and a cool microwave above the stove and a new playground and all this other kind of cool stuff in exchange for more rent, but I can give them a way better quality of life to stay pace with their wages. And I can help them live better through the wages that they're getting. And that increases my NOI, right? So I think that enough people aren't looking to see where things are going. And so because of that, I'm trying to think that way. And so we're going to be probably doing a lot of big acquisitions and, doing deals that make sense for where things are going, maybe not where they are now, if that makes sense.
Yeah.
Jack.
What's been kind of your success recently on winning those deals? I know a lot of groups that we work with too, it's just been so competitive. Are they off market because they're smaller or maybe more mom and pops?
We did the 152 unit that we did was a off the market deal we bought from not enough people go to property managers and ask for deals, right? So we went to our property manager and said, what do you guys know about? And they said, well, we're actually going to get into building because new construction, like I just said, right? So we want to get into building. We want to divest all of our Class B and Class C assets. And we said, ooh, put me in, coach. So he's already knew they were a good PM. So we said, if we buy that deal, we'll keep you on as property manager so you can keep the revenue. And so that was just the creative asks is how we got that deal. Secondly, we don't buy anywhere in the United States. We buy right now in 2 markets. So we're in Lexington, Kentucky, and the Piedmont Triad in North Carolina. That's it. So So I find that it's good to zoom in. I've heard a few people here talking about like Houston or Gallup, DFW, whatever. I think, Nick, that's where your deal is. So that's great. And that's a great market. And just like Nick's probably drilled into that market and just doing deals there. If that's, you know, or if that's what he's doing, that's awesome. We try to drill in and get to know every deal, every broker, everybody around certain markets that we're in. And that gives us the off the market stuff. But also, you know what, Jack, you also can't price in today's rents. And I think the biggest mistake people are making is they're undershooting where things are going. Like Marshall said, like this, right? They're undershooting when they underwrite, and they're being more conservative than they should be in projecting of revenues and things like that. And I think that's what gets you out of deals. So, but that's how we're winning, is by super uber focused on markets and asking not just brokers for deals, asking everybody for deals.
Quick question, just real quick. I don't know if this is up your alley or not, but if you're underwriting a deal right now, what are you thinking about in terms of like rent escalators?
Yeah, me and my underwriter have wrestling matches about that. You know, he's still doing like 3%, and I'm just like, man, but the market's doing 7 right now. You know, I got one deal in North Carolina. We have one deal in Winston-Salem, North Carolina, that we've increased the rent on this year 3 times. And the market keeps absorbing it, right? Not $25 a door. We go up on new release renewals on renovated units. We started here and we keep adding $25 to the renovated unit price, and the market's absorbing it at the same rate. At that property, we are sold out through the year of apartments, right? They're already pre-leased, and it's not schwanky bougie A class either. We don't do A class. We do C class, middle income real estate, you know, workforce luxury. That's what I call it. So that's getting absorbed really, really quick. And so I think Marshall, my underwriter, and I wrestle about these. You know, underwriters are supposed to be conservative, right? I think it's more like 7 is what we should be underwriting to, but he's underwriting to 3.
7 for 1 year or 7 for several years?
Per.
For like the next 5
I think
years.
you're going to see 7 per for the next couple of years. That's what I think. I don't know. That's what I've seen. That's what in the 2 markets we're in, that's what we saw conservatively this year.
Yeah, I can't argue. I'm just curious.
Yeah, but it's a historical. Again, I'm looking back, but I'm saying back through 2020, we've seen a 7% increase that in 2020 and 2021 in both those markets. And I can't ask. I mean, Nicholas has probably seen more than that in Dallas, right? So you got to look at where things are. And I mean, we've got to let go in this rising market like this. Conservatisms are going to talk you out of deals. So.
Hey, Matt, I got a 2-part question for you.
What's up, Cody?
No, I know nothing about your markets, and I can imagine that you're probably experiencing the same thing we are in Texas, where, you know, yields are getting thinner and thinner. So I'm assuming you're seeing the same thing, and that's kind of a assumed question, I guess. But the second part to that is, how are you conditioning your database to adjust their expectations with what we're seeing in the marketplace? Because I still think that you're hearing a lot of investors, oh, I still want the 15% return and blah, blah, blah. But we all know that it's hard to come by.
We tested the market. We were like, you know what? I'm going to call their bluff, man. I'm going to call their bullshit that they telling me they want 15 to 18% IRR, right? Okay. We put out a deal at 13.2, right? And it is filled right up, right? We tested what we could, just what the market would absorb, and so we're okay on a 12 to 13% IRR. It's a little more conservative, a little more lower than what I thought people would be okay with, but they're soaking it right up, and we haven't had to change our terms either. We haven't had to drop our equity splits or anything like that. I think too many syndicators think they still have to perform at 15 to 18 or into the 20s or whatever. If you can, that's great. You know, I mean, Nick, your deal's phenomenal that you just showed up there in Dallas. That's doing like, you know, 30% or 20% IRR. That's awesome. You know, and I think that's great, but I think that investors can't expect that, especially on the longer hold, because we are cash flow. So we hold for 10 years. That's another thing. We're not we get in, refinance it, and hold for the foreseeable future, because that's just, I think this inflation thing's going to keep going for a bit, and so I'm not interested in selling anytime soon. So we want to train our investors that this is like a longer hold cycle. And that's going to be like more cash flow, more like high single digits, low double digit cash on cash returns with an IRR a little bit more than that. Does that answer your question, Cody?
Oh yeah, no, absolutely. And I love asking the question because you get multiple different perspectives on how they're managing those expectations, which I think is important right now. So I appreciate that.
Yeah. Well, you can remember, you guys can either present appreciation or cash flow to investors, right? And maybe a little bit of both, but we're playing in Class C. It's more of a cash flow asset and all that, because that's just the world that we're in. That's where I got started investing in Trenton, New Jersey. That's where I got started on single family homes and everything like that. So I know how to manage C-class cash flow real estate. So that's just what we've always done. There's other asset classes that'll produce great returns for investors as well, but I know how to do cash flow stuff. And that's why people come to us, is from more like workforce housing cash flow assets versus like, rising market, top tier market, A-class stuff.
Hey, Matt.
Sorry, go ahead.
No, Matt, I was just going to ask, with these deals that you have, what kind of debt do you have in those deals? And a lot of deals are bridge right now, and the expectations of rising interest rates and floating rate debt. You're trying to lock rates in. How are you looking at debt?
So it's interesting, man. The first big, we did a deal in Kentucky like 3 years ago on bridge that was like 6%, 6.5% on like a $7 million buy price. We just locked in bridge at 3.25, right? On a bridge loan, and we can buy a rate cap on it and everything like that. So I think bridge is back. I'm very happy to borrow bridge. Especially on C-class. I don't think that we're going to see rates go up. Maybe a little bit, but not to like 5 or 6. And the other thing I like is, so we'll do bridge. I mentioned to Jack the Freddie floater. We've done a few deals on the Freddie floater, so we'll go. It's like going in agency day one, but it's a floating rate mortgage, right? And so you can, but it's good. It's still agency. It's flexible. You can exit out of it fairly cheaply. So the last couple of deals we did with that was we went in with the Freddie floater, and then we did all the reno out of equity, which all cash, which when you refi enables you to pull a big tranche of cash out. So it shows a big cash return at refinance, and you can push it over to a fixed Freddie mortgage. So that's what we like that, but we're not afraid to do bridge. It was getting a little dicey. It was getting a little too hot and heavy. It was like 80-85% loan to cost plus 100% construction in the beginning, a while before COVID. And I think bridge needed to correct and come back down because it was getting out of hand. So we're hearing more conservative numbers now. And what's funny, Nick, is doing the 32 unit, the 48 unit, and the 37 unit we're buying. I got to go to small community banks. Mm-hmm. So yeah. We're going to the bank down the road, one of those kind of banks. That's okay too.
Hey, Matt, question on the bridge itself. By the way, Akash Jain from Dallas, Texas.
What's up, buddy?
Multifamily, been in real estate a long time, but very new to multifamily. Have two properties under contract right now.
Congrats, man.
Thank you, sir. Question around the bridge itself. What I've seen is the smaller deals. I am actually in a 40-unit deal right now, looking to finance about $2.2 million. The bridge that I'm getting it as 5.5%. Whereas I was with another investor, they're trying to finance $14 million for a large property, and the bridge they're getting is 3.25.
Yeah, it's a different game.
So yeah, again, that's
it's a way different game because of the size of your deal. And are you getting construction financing too, or are you just getting acquisition?
No, it has some value add to it.
Are they financing that too, or are you doing that with equity?
No, they're doing $200,000 of value add on it.
Okay. I mean, we did like a $3 million deal a couple of years ago, and we paid 8%, man. I mean, it was, those smaller deals just get weird. I would get Jackson, here you go, Jack. I would get Jack's information,
I was going to say that the 5.5 sounds pretty high. I'm working a retail deal, small, similar size, and the retail deal is probably 4.5 to 5.5. Obviously different leverage points, but you can get on the smaller stuff, in the fours, I would say is realistic. Once you get up, you're talking more hard money rates and stuff like that. So I think there's some decent options if you're still looking.
Yeah, no, hey Jack, if you could if you can, I'll get the information. But now, my community bank is actually giving me 3.45 on a fixed 5 years. So, that's a pretty good rate. But then that's a recourse loan. So.
Right. Always a trade-off, and 5-year term versus going out longer or going floating shorter. It's always a balancing act. It's the fun part.
All right. Hey Jack, I'm going to hook you up here, right? Go in the comments section and put your contact information, because I think some of these folks might want to have a chat. You mind doing that for us?
Yeah, no
Nick's
problem.
nodding, Nick's shaking his head yes, which means you have his permission to do that.
Put it in there.
Yeah, but that's just your company name, Jack. Your email address, your phone
I'm
number.
working on it. I didn't know how to do the full paragraph there.
Jack's just like, Google me, Jack Arcadia. Right. Anyway, all right, cool. Charlie, do you have a question?
No, I was just following up on what you're saying about returns and what the investor expectation was, in that you able to fill out a subscription at 13-14% IRR. Is that not surely a function of your track record as well?
Yeah. I don't discount that we've been doing this for a good bit, and we've got people that are repeat investors. 52% of our investors are repeat investors with us.
Wow, that's huge.
So I don't discount that, Charlie. So that's maybe a good point, but I don't think that for you to get people's attention, you got to come in at 16, 17, 18, I think that I believe that LPs are going to start getting more realistic if they haven't already. And that if you've never raised before, then you maybe got to be a little bit careful about what you put out there. But maybe you're right. I'll just say that. Okay, I don't know. I just know it's been working for us to go 12 to 13% IRR.
Charlie, and also from a marketing standpoint, I would encourage you to remember it's better to under promise and over deliver. So even if your underwriting is showing 18%, maybe you put 15 out there, and if people bite on it, you just perform your business plan, hit your pro forma numbers, and people are going to love you.
Yeah, true enough. There was some clip I saw the other day with Grant Cardone, and he was suggesting, he was saying that, and I know some people love him, some
what's he selling? Right.
I'm reserving judgment, but he was saying that he'd removed all pref equity or pref.
Of course he did.
Pref payments on all of his properties or on his new deals when COVID hit. How do you feel about that? I mean, removing the pref, it's something that's transferred over to the multifamily sector.
Are you talking about a pref that he had deals that existed that were already syndicated, and he says, I'm not going to pay the pref on this?
No, Cody.
No.
On upcoming deals, he was not offering a pref.
Okay. So we were there. That was our video clip. That was in the mastermind that he just randomly showed up.
Okay, cool.
Yeah. So
That's awesome.
It was incredible. Everybody, I mean, you want to hear a bunch of grown men squeal like little girls. It's have Grant Cardone walk in the room. So it was pretty awesome. And the guy, we were talking this before we got on the video recording here. The guy is super sharp. I mean, like him or hate him, it doesn't matter. Yeah. The dude is really smart when you get him, when he's talking real talk. But his context of that conversation was he saw the correction coming, or he saw the impact that COVID was having, and immediately made the decision that, I'm sorry, it wasn't COVID. It was actually the tightening of yields as cap rates continue to compress. He saw that trend and said, look, we need to get away from the pref. Yeah. So moving forward on his transactions, he took away the pref. And the way he described it, and this is our thesis as well. Number one, it's like a chokehold. When you put that pref on, you're putting yourself in a noose because you have to pay that pref out. And most often, at least what we're seeing, is sponsor teams, the way that they're structuring their deals with this pref, they're not getting paid for 4 years. They're not getting paid to the very back end of the deal sometimes. And that's great if you want to take on that structure or whatnot. But the point to that is, if I'm a passive investor, I want my sponsorship team get paid, right? I want them being compensated for their work because I want them to be putting attention to the deal.
Yeah, they made plenty of money in the acquisition fee, Cody. That's it, right? I mean, that's all they, but you got, I'm joking, but to agree with you, I've seen 90-10 splits with a pref, right? Which is like, to your point, even if the syndicator puts some cash in, they've got no skin in the game, right? They have no attachment to the deal being successful. All they care about is the deal closing, so they get their acquisition fee, right? And there's people running around Texas right now that you guys are probably up against that are doing 90-10 plus a pref, right? So our thesis is that way as well. I mean, although I've removed the pref on a few deals and I've flirted with doing 80-20 no pref. Or even we looked at 90-10 on a forever hold, like 90-10, but I'm going to keep recapitalizing it and never sell it. Like seriously, we never sell it, 90-10 split to begin. And as we meet hurdles and as we buy investors out, we just buy more and more equity from them over time, but it's got to be like a 30-year hold for us, right? I think that there's way more than one way to skin the cat, Charlie. And to think that it's got to be a certain split plus a certain pref, it doesn't have to be that way. I mean, there's guys out there that are doing like I won't say his name, but there's a guy doing a 10% pref plus like a 20% equity split to investors. He's doing really heavy pref, but investors get a little bitty toehold. So they're getting mostly pref and a little tiny bit of equity. That's one way to do it. Other ways to do it is no pref, like you said. There's another guy out there doing 7% pref, no upside, and he does well. He doesn't get the investors anything above it. So it's about what you can present to your investors as value, and that they can feel like they're getting what they want to get from you, and that you believe, as to Cody's point, that your deal is going to be able to produce it. And that you're going to be able to get where you want to go with it, with that equity split. But there's no rule. The SEC is not going to come and say, hey, wait a minute, man, you have to pay a pref.
And Charlie
No,
too.
sure.
I mean, Cody, I don't know what you're about to say, but I would say not every investor is for every sponsor. So if somebody says they only invest in deals with a pref and you're not offering a pref, that's okay. You don't have to go back and redo your whole business model because you don't have a pref, or vice versa. Just to make sure you know who it goes back to your investor avatar, know who you're attracting capital, make sure it's transparent from day one that you don't have a pref model or that you do have a pref model. And you can have some really quick conversations. If you had a 30-minute call scheduled and they say they only invest in prefs and you don't do prefs, well, let's get you connected with somebody in my circle who does do prefs. That way you can just add value to them that way and then just move on.
And it's also a function of us being able to educate our investors as to how we wish to operate and bring them on board on that journey.
I think,
and show them the upsides.
Brian, it's a good opportunity for a conversation. If an investor tells you that I only invest in prefs, tell me why. I'd love to tell you why we don't do prefs, and I want to hear why. It's actually an opportunity to get to an understanding in that. But because I've had investors tell me they won't invest in deals where we take, they didn't like our acquisition fee, or they didn't like what our asset management fee was. And I've just had the conversation. Okay, tell me why that is, Going back to the pref thing, I mean, there's syndicators out there as well that are raising enough capital that can pay their pref out of investor reserves the entire life cycle of the deal, because so there's that side of it, which is a little, that can be dangerous as well. I'd rather see a no pref deal than just a syndicator just giving people their money back the whole time. I think you're better off doing it that way. So
yeah, we've seen that too, where, Cody, how many deals have we underwritten that don't pencil on an 80-20 split or even a 90-10 split, and then we throw a little 7 pref on it and it's humming?
Yeah, but where are you getting the 7 pref from, right? It's like, we just raised it. We raised it up. We raised enough money.
Exactly.
Yeah. Magic trick,
So Matt, I had a question. Are you doing recourse debt on your smaller deals that you're going to the bank for? Yeah.
I got a $5.8 million deal that we're doing it's like a $4.3 million loan, and that's going to be 25% recourse, and that burns off after 6 months. Then the other two deals, one of them is like a $1.2 million deal. I'm kind of, just doing what we got to do to keep the trains moving, right? Keep the investors happy. We're doing that deal. And then the 48 units. So those are clearly recourse. So I'm okay with that.
So you're going to go recourse and then refinance out to like agency. Is that the idea?
Probably. Yeah. But, honestly, like I said, I got started in Trenton, New Jersey. I'm used to personally guaranteeing on mortgages. It's funny talking to people that refuse to do recourse at all. At the end of the day, if you're not willing to put yourself on the line for your deal, I mean, we all have to go all in on these things, And so, and what do you think with me sponsoring a deal? If the deal really goes south, you think the bank's not going to try and come after me or try and find some sort of a carve out to get after me on, right? I think the whole concept of recourse is kind of BS. I think that if the bank wants to get their hooks into you, they will. And that's why they want to know about liquidity, by the way. Like, why do you think they want to know like the liquidity that people have in cash? Well, it's so that we know that it's there because we expect you, or we may enforce you to put that cash in to keep this deal going, right? That's why they want to know net worth, right? So they were like, what, if we had to, what could we get, right? So I think at the end of the day, if you believe in your deal and you believe that you're going to do whatever it takes to make things happen, or I don't think, and I'm not poking rocks at non-recourse for people that think that. I think at the end of the day, it doesn't matter because I'm going to do whatever it takes to make my deals work for my investors. So if I have to sign my name on the bottom line or personally guarantee it or this or that, it doesn't matter as much. It is a risk factor, but I don't think that to me, I don't take it as seriously as other people do because I'm already all in. It's my reputation. It's my credit. It's everything is on the line. If one of these deals completely blows up, and I can't save it, then, they might as well come take my house, which I'm not going to let it happen anyway. So we're that far committed. You burn the ships,
Right. So is your fee structure different for those at all, or is it pretty much the same?
No, I don't. Some people take like a sponsorship fee and that kind of thing. I don't do any of that.
Recourse fee. Yeah.
No, don't do any of that. Okay. No.
Cool. Thanks.
This was awesome. Any other questions?
You guys are asking a lot of good questions.
It's a good crowd.
Matt, you've been awesome, man. This has been great. We really appreciate you spending this much time with us, man. This is awesome.
Yeah, man. I went way over on your time commitment. I hope y'all stay out and network and abide by what Nick told you to and all that. So do some networking, do some offline stuff. I hope it was of value. I'm happy to come back and speak again. Thank you, Nick, for encouraging me to do my Michael Blanc presentation because at first I was lazy and I told Nick I wanted to just come and let you guys pick my brain a little bit, But I appreciate you getting me to give a little talk to you guys as well. So.
Thank you so much. This is awesome.
Where's my guy? Make sure.
Thanks for the one-on-one.
Yeah, my one-on-one guy. Where'd he go?
I'm right here. Yep.
Okay,
Don't worry, Eric's going to be at our next meetup.
You moved on my screen. Yeah,
I moved.
Make him show you guys some of the videos he's doing. Okay, all right. You hold Eric accountable. I want to talk to you in 30 days, Eric. All right.
All righty.
Cool.
Sounds good.
Good stuff. Thanks, guys.
Thanks,
Matt.
Thanks, Matt.
I can hang out. Are you going to break out the networking?
Yeah, we're gonna break out if you want to hang out or drop off, whatever you want to do.
Yeah, I'll hang out for a second, but I'm gonna drop when you split everybody out.
Okay. Here we go. Thanks for joining, everybody. People are dropping off. Great session with Matt. Thanks, Matt.
Figured I'm committed if I'm staying up till 8:30 or 9. Might as well keep going.
Hey, Nick, can you guys hear me?
Yes.
So I was just curious, has, due to the COVID crisis, you could say, well, not recently, past what, almost 2 years, but has there been any shift with multifamily investing in regards to, I guess, investing, not hoping, but looking for appreciation, cash flow?
Can you ask that one more time? I don't know that. I don't understand.
No, so I guess with just, you know, obviously investing in properties and whatnot, I don't know if this is more prone to single family versus the multifamily scope, right? But has there been any shift with focusing more so on long-term appreciation with the properties versus just current cash flow of the property?
Yeah, I mean, Matt dropped off. But I mean, I've had.
I guess if anyone can speak to it, right? I was just wondering.
Yeah. I think it depends on the investor. Everybody has a different thesis, right? If you're a cash flow chaser,
Yeah, for sure.
You're still looking for cash flow. I don't know. It just depends on your model, I guess. Cody,
I've heard from some investors saying like everyone needs to start shifting to like more of a cash flow mindset. I don't know if that's really true. I think that's just kind of another way to set investors' expectations for lower returns.
Yeah.
Well,
and I guess it also ties into long-term holds and not just if it's like a syndication where it's get in there, kind of up things and then get out, right? Obviously.
Yeah, I think you're going to find that more sponsors are going to be forced to move towards longer term holds to get whatever type of return profile. Because if you're buying properties on a 3.5, 4 cap, you're not really cash flowing. I mean, you're really just investing for more of the long term appreciation and equity. But it's very hard to cash flow on that. So I think you're going to start to see longer term holds, just depending on the particular asset and what the strategy is there. A lot of guys are trying to get in and get out. You know, like our A-class deal that we have in Dallas. I mean, we have a 3-year exit plan. You know, so you get out and getting it out. So, but it's going to be, I think it's going to vary between whatever market you're in and the type of deal that you're doing as well.
For sure. Makes sense. I was just curious. Thank you.
That's a good question.
Thanks, Tommy.
No problem. Thanks, Nick. Hey, thanks everyone else that's still on the call. Tonight was great. Definitely good to hear. So that was fun.
Thanks, ma'am.
Thanks.
All right. I'm going to push everybody into rooms here.